Welcome back to The Explainer. Today, we're going to do something pretty ambitious. We're cracking the code on general insurance. We're going to break down the playbook that powers this absolutely massive and, let's be honest, often super confusing global industry. So let's start with a puzzle. How on earth do you build a stable, profitable business on something as wild and unpredictable as pure chance? I mean, think about it. The whole industry is a paradox, right? They make predictable money from totally unpredictable stuff like car crashes and natural disasters. So, how do they pull it off? Well, the answer is actually pretty elegant. It all comes down to a powerful three-part ecosystem. And if you want to understand how insurance manages to tame all that chaos, you've got to see it through the lens of what we're going to call the three pillars: the theory, the engine, and the scoreboard. Okay, so here's the game plan. We'll decode the ecosystem, then we'll hit each of those three pillars: the theory, the engine, and the scoreboard. And then we'll put it all together to see how the system actually works in real time. All right, let's jump right in. Pillar 1, the theory. You can think of this as the rule book, the absolute foundation. These are the core principles and legal ideas that make insurance even possible in the first place. These are the non-negotiable rules of the game. And this is where the magic really happens. It's all about turning total uncertainty into something you can actually predict. This image shows it perfectly. It's the law of large numbers in action. Look, it's impossible to know if you, personally, are going to have a car crash this year. But if you pool together thousands or even millions of drivers, suddenly you can predict with amazing accuracy how many accidents that group will have. That funnel you see? It takes all that individual random chaos and distills it down into one predictable pool of risk. Okay, so first critical rule you gotta know, the principle of indemnity. And it's simple. Insurance is there to make you whole again. That's it. It's not there to make you rich. The whole point is to get you back to the exact financial spot you were in the second before something bad happened. No better, no worse. And this is exactly why that rule is so important. It stops something called moral hazard. That's basically the temptation for someone to, accidentally crash their car or burn down their own shed to cash in. As you can see, the payout can only fill the gap up to that indemnity ceiling. It can't go over. It makes sure insurance is a shield for protection, not a winning lottery ticket. All right, next up, another big rule that keeps the whole system honest: insurable interest. This one's easy. It just means you have to have some skin in the game. You can only insure something if you would personally lose money if it got wrecked. Simple as that. And this is the bright line that separates real insurance from just a plain old bet. You see it right there. A valid policy needs that direct financial link, that solid chain connecting you to the thing you're insuring. But what about insuring your neighbor's house, hoping it burns down? Nope, that's the invalid state. The chain is broken. That's not insurance, my friend. That's just gambling. And it's a huge no-no. Okay, so we've got the rules down. Now let's get into Pillar 2, the engine. If Pillar 1 was the rule book, think of this as the actual machinery, the factory floor. This is the day-to-day operation that keeps everything moving. So every single insurance policy goes on a journey, this 5-step life cycle. It starts with submission, that's the application. Then it goes to underwriting, where they figure out the risk. If it's a go, it gets bound, meaning the contract is official. Then, during its life, it's serviced, any updates or changes. And finally, it hits renewal and boom, the cycle can start all over again. Now let's zoom in on the first 2 steps, because they are absolutely critical. On the left, you have submission and intake. This is all about getting good, clean data. And that is everything. Why? Because if the data is garbage, you can't even get past the gatekeeper on the right, underwriting. This is the brain of the operation. This is where the insurer decides, do we even want this risk? And if they do, how much are we going to charge for it? And here's the thing. A policy is not a set it and forget it kind of deal. Nope. It lives in this constant maintenance loop. Once it's sold, it's always being serviced. Maybe you buy a new car or change your address. And then at renewal time, everything gets looked at again. The price might change, and it loops right back to underwriting to be reevaluated from scratch. All right, so we've got the rules, we've got the machine. Now for Pillar 3, the scoreboard. This is all about the money. How does the business actually keep score? How does it stay afloat financially? And I love this metaphor. Think of it as a cash flow engine. All those premiums you pay, that's the fuel getting poured into the tank. That money then sits in a storage tank, we call it reserves, just waiting. And the cash goes out through 2 exhaust pipes. The big one is for paying claims.
And there's a smaller one for all the other costs of doing business, expenses, commissions, that kind of thing.
But what happens when something huge hits? A massive catastrophe, a hurricane, or a giant wildfire, and that main claims pipe just bursts wide open with money flooding out? How does the entire system not just drain dry in an instant?
Well, the answer is a really clever invention called reinsurance. And it's exactly what it sounds like. It's insurance for the insurance companies themselves. So, for their everyday book of business, they might use something called treaty reinsurance. Think of it like a giant safety net that automatically covers a whole bunch of policies. But for a single gigantic risk, like, say, an offshore oil rig, they'll go out and get a custom made facultative shield. It's the ultimate shock absorber for the system.
And, of course, to keep that scoreboard honest, you have these 4 pillars of financial discipline. These are super strict accounting rules. For example, they force companies to match their expenses with the revenue from the same period. The whole point is to make sure the financial statements give a true and even a little bit of a conservative picture of how healthy the company really is.
And then, watching over this whole thing, you have an external regulatory shield. These are the government regulators, and their job is simple: protect you, the policyholder. They set really strict rules about how much cash insurers need to keep on hand. They're there to make absolutely sure the company can always pay its claims. Because without that, there's no trust and the whole market falls apart.
Okay, so here's what you really need to get. These 3 pillars, theory, engine, scoreboard, they don't just exist in separate silos. They are totally interconnected in a dynamic feedback loop. Let's put it all together and see how.
In this diagram just nails it. Follow the arrows. You see how risk assessment from our theory pillar feeds right into underwriting in the engine? Then, the engine's operations crank out premium income, which shows up on the scoreboard. And when a claim finally gets paid out, that payment has to follow the principle of indemnity, which snaps us right back to pillar 1, the theory. See? It's all one big connected circle.
And that's really the big idea here. Insurance isn't just a product you buy. It's a living, breathing system. It's this continuous feedback loop where the legal rules, the day-to-day operations, and the financial health are all completely intertwined. So now you've seen the whole machine, all the gears, all the pipes, all the rules. It makes you wonder, right? What's the weakest link? If this thing were to break, what part do you think would crack first? Definitely something to chew on.